Sound off.
What's up, guys? Welcome to our live stream today. It's been a minute, but we have a lot of companies to talk about. Ones that reported yesterday, ones reporting today. The NASDAQ is down about 0.5%. The Dow is even. S&P is down about 0.2. As we discuss all the time, you guys have noticed, the NASDAQ has been leading the losses as it goes in the gains. Why is that? Well, the leading companies, the ones that take up the most market cap, are NASDAQ driven. A lot of AI, a lot of software, a lot of tech. Remember, tech has a great ability to compound on its earnings growth, compound on its earnings, and get you outsized returns. With that said, that means as things go down, it's going to be probably the ones that lead the way. The NASDAQ peaked in March of 2000 and fell 83%. But if you dollar cost average from the peak, starting at the peak, rode it all the way down to today, you got about a 15% annualized return, which is incredible. Now, we're going from what was a bubble back then to what I think is a bubble today. But the point is, even if it fell in half from today, 25 years falling in half, it only takes the returns down to 11 or 12%. So it's still a really good return, even if the NASDAQ fell in half today. Now, PayPal reported yesterday, beat on earnings, beat on revenue. You guys saw our video on our 24/7 channel right here, and they still were down a lot. Today, AMD is down a ton. We have Dalton in-house. Dalton's our very active community member, works for us. He's getting a lot of attention from a lot of very famous people. Somebody slid into his DMs. Phil Mickelson has liked a couple of his tweets, which reminds me, guys, if you want to follow me at EM Paul G, it's on the screen. And then right down here. And then also Dalton. Dalton, what's your name on Twitter?
It's Daily Compounder.
Daily Compounder on Twitter. If you go to my follow, who people I follow, you'll probably see it. But at EM Paul G for me. So AMD, Dalton, this is a company you've looked at a lot in the past. We talked about it a lot in the past. It is down 10% today, $12.75. I already forgot what they reported. This is how many videos we do. What did they report yesterday?
Let's see.
Is it up there? No, it's not even up there.
It's not up there yet.
Because we did it yesterday.
Yeah, let me pull it up.
But either way, AMD chip maker, guys, this is a company. Look at this chart here. It was down as low as like $1.65 a share back in 2015.
So AMD, Paul, they were estimated to do 7.53. They did 7.66.
They beat.
Yep, by 1.75%. And then they had EPS estimates of $1.08, and they did $1.09. So they
beat on both.
Palantir and beat by a penny.
Yeah, they beat on both. They're down 10.5%. Palantir beat. It skyrocketed like 25%. I mean, it's really random how things work. And remember, we talk about it all the time. We don't care about short-term earnings results. If you're into a company for a long period of time, what matters is what's going to happen over the long haul. I do not look at my brokerage account in terms of, because I don't want to see a stock going up and think even better. I don't want to see a stock going down and feel crappy. That's what I choose to do. I let Dalton do that for me. And then sometimes they'll tell me, hey, Paul, you have a lot of gains here and you have some losses we can offset. Why don't you just go ahead and sell? I'm like, great, sell all the short-term gains, blah, blah, blah. We're going to say, Dalton.
The data center segment for AMD grew 70% year over year.
Jeez.
Holy hell.
70% year over year. 70%.
And then their data center segment, let's see here. AMD reported annual revenue 14 driven by 94% growth in data center segment and 52% growth in client segment.
All right, let's look at Disney real quick. Disney's another stock I own. Don't buy anything because somebody on the internet has it. Down today, even though they beat on both revenue and profit. They did earnings per share of $1.76 when they were expected to do $1.42. That's a big beat. That's a big, big beat. Revenue came in at $24.7 billion versus expected of $24.6. The stock is down. What's the reason?
I don't know the reason. I mean, I really don't. It's just some of this stuff is just.
I'm sure there's a reason. They said they probably guided
probably
poorly.
They attribute to it. But here's the thing I think is most incredible about Disney. They have basically been flat for how long now? A decade. And Bob Iger has yet to be booted. Like the fact that he's stuck around for as long as he has, it's truly remarkable. Everybody else, like even Southwest
What's flat
Airlines,
though? What's flat?
Like their stock price is flat.
Okay.
Right.
They're up 20% in the last 10 years, not including dividends. To Dalton's point, let's go look at the financials.
Then you get like Elliott snapping at their heels.
But here's what's interesting. $52.5 billion 10 years ago, $91.4 billion recently. I have a similar thesis on Disney that I have on Southwest Airlines. Their margins have been absolutely beaten down since COVID. Once their margins go back to where they should be, I believe it's a company that's going to generate a lot of profit and have a lot of excess cash flow to buy back shares. They should stay down or pay out in dividends, which is, didn't they reinstate their dividend? Yeah, forward dividend 1.59%. Free cash flow in the last 12 months of $8.6 billion versus net income of $5 billion. So their price of free cash flow currently is $24 billion. Let's see what it was at its peak. Sorry. Yes, but their peak, their free cash flow average in the last 5 years is $4.5 billion. All right, before 19, they were close to $10 billion. And now they're at back up there. And this is a company that I think deserves a premium. At $8 billion with a market cap of 203, all right, it's a lot, but you wonder yourself, like, is this a moat business? Can you justify paying a premium for this? Maybe, maybe not. I don't think I liked it at 111. Yeah. I forget what I did.
I thought you were closer to like 80 or 90.
I think it was 85 that I liked. Let's pull up my previous stock analyzer.
The other thing too, Paul, is how many times has a company that's been around for 100 years totally changed their operating model like they've done? Like they've gone from, they were in the television business with like ESPN and all that, and now they're totally switching to a subscription base. Like there's going to be aches and pains for that in terms of profitability. And on top of that, they have implemented not just subscription services within like their Disney Plus and the streaming service, but also if you go to their parks now as like going on vacation, everything is a pay to play. Like to get in line for a ride, to skip the line, you're going to pay $30-$40 per ride. Like, and people pay it because it's like we're taking a vacation once a year. What's an extra couple $100 to do?
Yeah, that's true.
And they get 50,000 people that go to each park per day. It's insane.
So guys, this is, I think, a very beaten down version. I have 10% in here. I just changed this to 10% for profit margin and free cash flow margin. Even though the last 10 years, they've done pretty close to 9%, 8 to 9%, with this 5-year being absolutely terrible. And I still have a mid price of 110, which is basically where it's at. Remember, this return includes dividends. So for me, I'm looking at going definitely sub 100 for me. And I think I bought shares at like 85, 90, 90, something like that. So listen, that's the way I look at it. Any comments about Disney in this chat?
I think people are pumped about. Did you see Uber today?
So let's look up Uber now.
They were down 7% at one point, and they reported great earnings. I mean, they missed on.
They're down almost 8% right now.
Yeah, they missed on earnings, but like I thought,
11.96 billion in revenue versus 11.8 expected. So they beat on revenue. Wow, that's a big miss on earnings, Dalton. 48 cents expected. They reported, 23 cents. That's a big miss.
It is a big miss, but it's like you also went from a company that just a few years ago, I mean, during COVID, it seemed like it was kind of like it was pre-revenue, pre-earnings. Like it was something.
Well, remember what the CEO said after COVID?
Cash flow matters now.
Cash flow matters now. So it was actually in 2022. He said that, I believe.
Yeah.
Look at this cash flow, Dalton. Last year, $6 billion in the last 12 months.
Yeah. You see their CEO said they're going to start buying back stock. They feel like they're undervalued. That's what he said.
Did he actually say those words?
He literally said that. There's a quote. I saw it on Twitter this morning. That the CEO said that they believe that they're undervalued and they're going to start opportunistically buying back their stock.
Man, I'm really surprised the CEO thinks they're undervalued. You know who else said that? Ken Lay, right before, like $110 a share before Enron went to zero.
Yeah.
Or maybe it was 70 and he said we're $110 stock. I don't remember.
I think the other thing that's hard for like us as outsiders to determine is like, where does the company go? Because right now it's a ride hailing service. It takes you from point A to point B, but like there's an opportunity for like logistics, like somebody who, like a moving company who needs to contract out a couple extra cars.
Well, they already have it for Uber Eats and and things like that.
Yeah.
That's definitely out there already.
The question is like, how do they boost earnings per ride? How do you do that?
Have you looked at don't look at their numbers. What do you think their gross profit margin is?
72.
So it's funny. I thought it would have been higher than it is. It's 40.
Oh, wow.
I would have thought it'd been much higher than 40.
Interesting. Do you think that they keep their drivers contracted, or do you think they end up becoming employees at some point? Because that kind of kills everything if they end up being employees.
I don't know does it kill it, or does it just make it
changes the cost structure for sure?
Yeah, let's think about that. So to me, okay, here's the thing. Here's what's interesting. The rules, and I'm going off memory. The rules on how you talk about an employee versus a contractor. You can't tell them when and where to work, which is true for Uber.
Yes.
Those are the two biggest things. Like you can't tell them when to work. You can't tell them where to work.
Yeah.
If you're a driver for Uber, you decide when you drive.
Yep.
You decide where you drive. Yeah. You can go move city to city. It does not matter.
Yeah.
Right.
But now there's like this backlash saying, like,
you know why there's backlash? They want the freaking revenue. They want the earnings, right?
Well, they want to turn. If you do that though, you turn into taxi services. You just turn into a taxi.
Yes, correct. Yeah.
I mean, their gross bookings are up 20%. Free cash flow was up 106% in 2024.
Wow.
3-year outlook is they're going to have 90% plus growth in free cash flow. And that their gross bookings are going to grow at mid to high teens CAGRs through 2026.
So here's my stock analyzer on Uber. I did 6, 10, and 14% revenue growth for the next 10 years. Is that a lot?
I didn't think so.
Is 10 a lot? No?
I think they're still pretty small. I mean, it's great if you factor in like all of the opportunity with full self-driving and all these other.
Yeah, but is full self-driving give Uber the benefit or Waymo with Google the benefit?
Well, I think there's opportunities for partnerships there that are lucrative for both parties. If you can go in as Uber and you can say, hey, half my fleet's going to be Waymo. It's like.
Well, what's interesting about Waymo is it is cheaper than Uber, but people I knew who took it were like, it wasn't as cheap as I thought.
Yeah. And I think actually full self-driving probably has the advantage over Waymo for now. I think they have an advantage.
So people would just say, I just want to have my own car and then have full self-driving for it.
Or Uber buys a fleet of Teslas that have FSD and then they just take everybody around.
Well,
and it cuts down driver costs.
That makes Tesla a software business. Is that triggering?
Uh-oh.
Is that triggering? So anyways, Uber right here. I did 10, 15, and 20% for profit margin and free cash flow margin. But you're telling me that they're talking about 90% growth in their
free cash flow through 2026.
So maybe, guys, this could be very low. This could be a very, very low profit margin. I did 15, 18, and 21, hit the analyze button. I mean, it looks very interesting. This is on like 15% free cash flow margin and 15% profit margin. They did that in the last year. They're going to grow. They're not going to grow their revenue 90%. So they grow their free cash flow 90%. Yeah. That takes their profit margin. their free cash flow and profit margin 15% to what, 25%?
Yeah.
If you balance out earnings growth, revenue growth.
Yeah. Well, the other question is how if you're Uber, how do you bring down your cost to acquire a new customer down? Like,
what's their cost to acquire a customer right now?
So I'm going to look right now.
Uber is one of those tough ones for me, guys, because I feel like I want to own Uber. I look at this and I'm like, okay. And by the way, they're the clear leader. Like, I know Lyft is out there, but Uber is clearly the leader. Yeah, it says right there, Michael Dearman, absolutely agree with you. Is Lyft a better buy than Uber? I don't know, Nex.
I think this is kind of a winner-take-all business, though.
I don't disagree with you. Yeah, I think you're right on that one. I don't think this is one of those things. I think it's...
So, just so you know...
Have you ever used a Lyft? I've never used a Lyft.
So, it's funny. Last time 2 times ago I was in town. I was trying to get an Uber because I'd flown into Cleveland. I was trying to get an Uber from the hotel early in the morning to the airport. Couldn't find an Uber. Like, it would take forever to load. Went to Lyft. It was half the price, and they were there in 2 seconds. It took me. So I think it's regional. I think it's like if you have Lyft drivers, you have Lyft drivers.
So how do they do half the price though? With Uber's margin of gross margin, let's see what Lyft.
So by the way, just so we have this out of the way, I'm seeing CACs at around $20 to acquire a new customer. About $20 to acquire a customer.
And look at this. Lyft is less money. Look at this gross margin, 41.3%, a little bit higher than Uber's.
Wow.
$20 to acquire a customer?
That's what it says. Their CACs have been around 20% since 2019 through
20% or $20?
I'm sorry, $20. And that's through 2019 to 2024 has been around $20.
So guys, what did I just hit? So guys, a $20 acquisition cost for Uber to me just sounds so freaking low. $20 to acquire a customer?
That's what it says. And you think about it, how many rides does it take? I mean, and how long?
They said it takes 2 rides, you're hooked for life.
Yeah.
$20 to acquire a customer. God damn, that's low.
If you think about it now, though, that's probably like you don't have to advertise Uber. Like, everybody knows, like, what Uber is. And they, I feel like everybody's probably...
It's the verb.
Yeah.
Nobody says, lift me to, like, Uber.
Yes,
you don't say lift to another location.
Like
you say, yeah.
Kind of is. And it's like, the other thing is, it's like that rap, what was that rap song, Uber Everywhere? They probably paid.
Is there a rap song called that?
Yeah.
Called Uber Everywhere?
Yeah, I think, yeah.
You think they had a little joint collab there?
Yeah, probably.
You think the Uber meals delivery may be weighing on their gross margin? You might be right. That's true. That's possible.
And I think too, Paul, and correct me if I'm wrong.
The reason I'm spending so much time on Uber is it's because it's a company I do want to own.
Yeah. And correct me if I'm wrong, but don't you think that part of the Uber Eats and some of the other stuff is just to keep you in the network? Like, they probably are breaking even.
I agree
on
with
some
you.
of those things. And then maybe
so that's to his point.
Yeah.
That's to Michael Dearman's point that Uber meals Uber Eats are driving down. Is there a way to see what the gross margin is for Uber driving versus like Uber Eats and stuff like that?
Yeah. Let's look it up.
Man, Uber owns my brain, literally, because I look at this going, $138 billion market cap. Is Uber, like, what does it take for, like China's got their own Uber. India's got its own Uber. Yeah. So you don't have Uber in those countries.
Right.
They can easily, that's something they can easily do in other countries without.
You also have to have cars per capita to be able to do that, though, too.
But they're growing.
Yeah, that's true.
They're growing. That's the thing. The number of cars per person and the number of people getting wealthier enough to be able to justify taking these car. Man, I'm stuck on the Uber thing. What are you guys laughing about? Oh. Well, here's what's interesting. In May of 19, they went public. They hit a low of 36. So not much higher than their IPO price. Isn't that interesting?
Yeah.
Guys, good example here. Their low, let's see where their all-time low is. $19 in July of, is it 19? Oh, no, $13. Look at this. In March of 2020, this was, you know why this was? This is COVID. Yeah. Hit a low of 1371. So taking out COVID.
So Dearman, by the way, is absolutely right. So the profitability, gross margin wise, for a ride to somewhere is around 40%. The delivery services are closer to 25%.
Well, but then why is their overall margin still 40%?
Because maybe it's a much larger maybe piece of the pie.
That has to be 100% though.
Yeah.
You know what I mean? That doesn't add up.
Maybe there's something else that we're missing.
Interesting. Let's look at their revenue. I mean, look at their revenue, guys. In 2016, they did 3.85 billion in revenue. They did 42 billion in the last 12 months. 42 billion. And the stock is basically the same as it was back then. Isn't that incredible?
Yeah.
Oh, no. Sorry. 19, they did 13 billion in revenue because they had data on previous years. 13 billion in revenue. So they're 3x. They're 3x. Okay,
so they actually have it here. I don't know if you guys can pull my screen up so people can see. So here is the EBITDA broken out.
EBITDA.
So mobility was 1.7 billion. The delivery was 727 million. They lost 22 million in freight. And then, so what was the revenue? Did they break it out by revenue? Because that'd be nice to be able to get an EBITDA margin, then you can kind of compare. See if I can find.
I think Uber is a very, very interesting company to consider. It's clear they're the market leader. I mean, that's absolutely clear. Is anybody even questioning that? No. It's clear that their profitability is getting better. Is there any question of that? No.
The question is, can you pay a decent price, or even I think the problem here is like, can you estimate with a reasonable amount?
That's the hard part.
3 to 5%, timeline for them.
3 to 5 year.
3 to 5 years. Sorry, yeah.
100%. That's my issue. And I'll probably be too conservative is my issue. Yeah. That's my problem. Is I'll probably be too conservative.
Okay,
but it's still making sense of my conservative assumptions.
So they did 727 million in EBITDA on 3.773.
I hate EBITDA.
And so they have it's a 20%, 19% EBITDA margin for delivery.
EBITDA makes me want to kill puppies.
And then, wow. So they did 20% EBITDA margin in delivery, and then
Although I will say this, if you look at their CapEx,
it's 26% for mobility.
It's not high. Look at this CapEx the last 3 years. In the last 12, I mean, it's very low. They had way bigger CapEx here. I mean, look at this. Declining CapEx over time.
Yeah.
What's their CapEx on?
And that's what I really
What's
don't
their
know,
CapEx?
Maybe building out like service, I don't know, offices around so they have hubs of people. I don't know. I honestly don't know. Corporate structure or something. Because the
software,
the cars and the insurance, that's another part of it. The insurance is held by the driver, not the company. So you're not insuring those people if they get an accident.
Well, that wouldn't be CapEx anyhow. That'd be operating expenses.
Yeah. But I'm just saying in general, like they keep a lot of their costs low.
Who here has Uber? Right? Uber, if you have Uber. Leopold, you're right. I wish you should. Dalton should just go sell my my Intel shares and not even tell me. I don't think you have the ability to. Tim has Uber. Tim, you have Uber? Awesome.
That's funny.
Okay, let's go to another company. I want to talk about Ferrari. Guys, Ferrari just minted. Ferrari, RACE, race. Let's see how their stock is doing, because I'm going to show you how. The stock is actually flat. Guys, they crushed. They were expected to do 1.66 billion in revenue. They did 1.85 billion. They're expected to do $1.82 in earnings per share. They did $2.28 per share. What's up?
So for 2026,
their
order book is already covered through the entire year of 2026.
Who, Ferrari?
Yeah.
You know why?
Because they only make so many cars.
Listen, the last time I checked, they did like 13,500 cars. How many did they build in 24?
In 24? What was it, 13,000 or something?
No, I think that was 23.
Let me look.
Guys, Ferrari's one of those companies that if they wanted to build 50,000 cars tomorrow, they would. That's what I love. They're sitting there saying, nope, we want to make sure that people have a high demand for our products at all times.
13,752.
In 24 or in 23?
24. Ferrari delivered a record 13,752 vehicles in 2024.
Well, they didn't increase that much from 23.
Not even a percent.
Good for them.
It was just 0.7%. And so this 12 cylindry is like the big car, apparently.
Now you have an issue with me on this one. This is my biggest problem with Ferrari. Free cash flow last year about $1 billion, 5-year average about 600 million. Big difference from its net income. We've had this conversation 8,000 times.
Yeah.
Explain to the good people of Everything Money what your thesis is on that.
Well, let me pull up their financial statements.
So I think Dalton pulls up their European, their Italian financial statements.
Yeah.
And he doesn't pull them up. I think he means currency. They're buying back shares, Leopold. Wow. Yeah, I don't know. Oh, you own Ferrari. Great. Real Nick, what'd you pay for your Ferrari shares? Oh, Ferrari. It's probably one of those companies I'll never own and regret it every single time it keeps going up. I hate this discrepancy right here. And Dalton seems to, look at this, gross margin, 50%.
Yeah.
Last 12 months, 22%. 5-year average, 20%. If anybody's going to call a company not a car company, this is the company you call not a car company. You know why? Look at this return on capital. When have you seen a car company that has this kind of return on capital?
You don't.
It's impossible.
No.
When you see a car company with these kind of margins.
It's closer to software.
Yeah, exactly. This is closer to software than to actual car
Ferrari
companies.
a software company?
And well, they're trying to get all. I bought some Atcore. We're going to talk about Atcore today. Don't you worry. Oh, good job, Real Nick.
So the rationale that I just read was that it's because of CapEx on new cars and building out new factories.
But is that actually true? Who said that?
That's what it's pulled from a company press release.
I got to understand. This is where, guys, so here's the deal. This is where I want to talk about. I want you to hear from me to understand the way I'm thinking, only because, one, it could be completely wrong. And two, if you like what a company like Ferrari, I want to understand these like how many, if you're building the same number of cars, what factories are you building?
That's a good question.
Unless you're going to like massively increase development.
For parts or something, for different parts.
So that's the thing. We got to find that out.
Yeah. The other thing is too about Ferrari that gets overlooked. They have a really strong licensing business too, because they have all the rights to all these other side products. Those are really high margin for them, like super high margin. So the licensing business usually gets overlooked because the cars are so cool.
How big is the licensing business? Like in their revenue?
Yeah.
Their revenue in 2023, last year was $6.73 billion.
Yep.
What the fuck was their licensing revenue on $6.73 billion?
Yeah, I want to look it up for you right
now. $500 million? Probably was way more than that. I'm just being an idiot. Listen, I tell this story all the time. My wife and I went to, hey guys, can you double check the Uber EPS number? Somebody's telling us that that's not correct. The 23 cents we announced. Dalton, you don't do it. I'll do it. Okay. You keep working on that Ferrari stuff. Uber earnings release. Let's see. No thanks. Yeah. Let me look at the EPS.
Well, that's interesting. They said they're going to cut their licensing.
No, right here. This is right here. I mean, the only thing difference is we said 48 cents estimate. They say 50 cents. That's Uber.
Right off of Earnings Hub.
Yeah. So I don't know unless you're missing something. All right. What'd you say about, and then also what does it cost to develop a car? Because let me ask you a question. If you spend $200 million developing a car, how long is that car around for? So like how many years are you selling that car for? How many units are you selling? I mean, you just got to I look at that going.
Yeah. Because they have so many different cars they can sell.
Dalton, do you see my issue here? Like I look at this free cash flow versus, and it just, I don't think to me, I'm surprised Ferrari would have much higher CapEx when they sell such few cars and they tend to keep the lines around for a long time.
And maybe some of this CapEx is because they're changing everything to electric.
Well, that's actually what I was wondering.
Yeah.
Because how much their CapEx has increased a lot.
Yeah. Which is stupid, by the way. I'm sorry if anybody in here believes in that, but I think it's stupid.
What?
Changing to electric cars.
Listen, the world's changing. The world's changing. I love electric cars. We had a Taycan.
Okay.
Go ahead, Dalton.
I have to get this out.
Get it out.
Wind, solar, electric. We have never moved from a more efficient energy from an EROI perspective backwards. That's what you're doing when you build these things out. You are less energy efficient. It takes you 100. It is 100 times more expensive in terms of energy to move you a mile in a car from an ICE to an electric engine. If you actually go to how it takes to build out the engine, to build out the component parts.
I don't disagree that the story on electric is quite exaggerated.
It is.
A lot of people who I know say that hybrid is the best version. At the end of the day, though, if the people want electric, you give them electric. And let me tell you something, guys. Electric vehicles are fast as fuck. We had a Porsche Taycan.
We drove that one time to the car.
How fast was that thing?
Too fast.
It's awesome.
Yeah.
And I didn't even have the souped up version. I had the basic version.
Yeah. So this is too a chart I have pulled up here from Ferrari's release. This is all the different cars that they have developed since 2011. You got 1, 2, 3, 4, 5, 6, 7, 8, 9.
Hans said supercars generally stay in the market 6 to 8 years versus 4 to 6 years for non-exotics.
24 different cars since 2011.
Ferrari?
Mm-hmm.
I think for me to understand Ferrari, I got to understand the CapEx. That's my big hindrance.
Yeah.
I got to understand the CapEx.
Yeah.
Hey, Nick or somebody, can you guys get me a Coke Zero? Thanks.
This is as stupid to me as Total Energies getting into renewables.
You know what I want to do? I want to make nuclear powered cars. You just put a nuclear engine in every car, a nuclear plant.
Don't threaten me with a good time. So here you go, Paul. You talked about the CapEx. So let's break this out. So this is for full year 2024. So they had $989 million in CapEx. They had research and development costs of $563 million. And they had amortization of capital development costs of $331 million. So it's saying total research and development, A plus B, which is CapEx plus research and development. They did $1 billion in research CapEx, development CapEx.
That they actually capitalized.
That's what it says.
When?
In 2024.
But their whole entire... No, I don't believe that.
It's just what the full year 2024 numbers.
Because look, they have research and development right here as an expense number. And then on so 2023, they're showing $917 million in research and development expense. Yeah. And then you go to CapEx, and you have another $882 million.
Well, by the way, R&D should be capitalized, but it's treated as an OpEx, but it shouldn't be. Research and development should be capitalized.
So do you know why that happened?
Why?
It depends, because years ago, what companies would do was they would hire tons of people, call it all research and development, CapEx it, and then you'd have your net income showing a huge number.
Yeah.
I think some research should be CapEx and some research should not be CapExed. I think maintenance research should not be CapExed.
Yeah, I don't think so either. But like research and development on its face is by definition it's a capital expenditure. It's something
that's expired.
You're putting out money today to get a return in the future.
Let me make sure I'm right on this one. Yep. Literally got that piece up there. Yep, that's expired a month ago. God, I'm so good.
I don't know. Especially if it's something like that you can actually put a useful or like a commercial life on. So, okay, I put out money in year 1. It's a 7-year capitalized expense. At year 7, I have a commercial product that I can sell. Like cars seem like they'd be the easiest thing to mark out.
So, right? Like, for example, software. Like, we have Everything Money software, right?
Yeah.
Since we basically built the Everything Money software and it was revenue generating that same year, it's like the rule is when you create software, you capitalize all the software, and the day you put it into use, that's the day you get to expense it. I don't know how it is with Ferrari.
Yeah.
All right, guys, you want to go to another one? T. Rowe Price, another company I own. All the companies I own are losing it. What's T. Rowe doing? Down 3% to 112. Reported $1.83 billion in revenue versus $1.87 billion expected. Reported $2.12 in EPS versus $2.20 expected. This is a company that I think is going to suffer if the market suffers. Okay, so the market goes down 50%. This company's going to suffer greatly.
Yeah.
This company's down a lot from its all-time high of 224 back in 2021, coming off a big surge of everybody getting into investing, et cetera. And even though the market's much bigger, look how much the stock has fallen since 2021. That's incredible. Free cash flow, not as good as net income. Definitely not as good. Big dividend here. eats up vast majority of their cash flow.
They have $1.6 trillion in assets under management, though.
They have a lot.
That are insane.
They have a lot. Let's pull up my my stock analyzer on T-Rizzle.
I want to do one too.
The thing is, I'm going to do a 20-year analysis on T-Row. I'm going to do 3, 5, and 7% revenue growth. I'm going to do 26, 30, and 34 for profit margin. I'm going to do 22, 26, and 30 for free cash flow. PE 15, 17, 19. The current PE is 12 and 9% desired return. Hit the analyze button. This is why I'm interested in T-Row. Look at this, Dalton.
Good Lord.
Yeah, a lot of green here.
I'm doing one too. See what I come up with.
The interesting part is the highest numbers are still above their all-time high.
Do you think they deserve? You just think they deserve a premium then with those multiples, right?
Absolutely. Okay. I actually wonder that premium's not enough.
Really?
I mean, they have declining ROIC, but I think that's based on the way the business has gone lately. But the last 10 years, their ROIC is 17%.
So I got all green except for my lowest assumptions.
So what'd you get?
I got low end of 107 to 89. I got high end or the middle of 144 to 122, and I got a high of 166 to 186.
All right, you're lower than me.
Yeah. But it's also not something I would probably.
And I did a 20-year analysis.
Yeah, I did 10.
Let me go to 10 years and see how those same assumptions play out.
It's going to be bananas.
Much lower.
Yeah.
Much lower. Wasn't it? Yeah, it was.
Yeah.
All right.
You know who else is out that I think people were somewhat interested in too?
Who?
Enphase reported.
Yes. You want to look up Enphase since it's solar panels?
Let me pull it up really quick. Yeah, let me look it up really quick.
You're right, Zero G. A lot of people are moving to low margin index funds, but there's still people out there who want to put money into direct funds to try to beat the market.
And then also Atcore reported they were down 20%. That's the one I think that you were interested in at one point. It's a materials business, but it was down 20% after it reported. It's at like 5 times earnings right now. Press releases, reports, fourth quarter. So Enphase reported quarterly revenue of $382.7 million, 53% GAAP gross margin, shipped 2.01 million microinverters.
Let's look up their stock right now.
78 megawatts, 152.
This is the most stable Enphase stock has been. It's only up 2%.
That thing whips.
All-time high. Look at this, Dalton. 2 years ago, 340.
Yeah. That was peak ESG.
Was it?
I think so. Because if you look at like Davos even or like all the conferences people were
52-week low, $58.33, 12 days before Michigan beat second-ranked Ohio State.
Never forget.
Never forget. Hashtag never forget.
I'm a Hawkeye fan, by the way, but I'm not a big fan of Ohio State. Free cash flow of basically 160 million.
In the quarter?
Let's see. Financial highlights for the fourth quarter. Yeah.
Wow.
So
wow.
They spit out cash. There's also some stuff here that I have read about before because somebody in the community talked to me about Enphase. There's something with California is obviously a big state for them in terms of install base.
Of course.
And California, the way that they're metering some of that electricity is disadvantageous to the consumers. So there's
really?
Yes.
California's taking advantage of people? Huh. I'm very surprised by that.
So if you are interested in Enphase, you got to understand the California regulatory environment, which is basically a third world country. Basically, it's that movie Blood Diamond with Leonardo DiCaprio. Gross margin's been pretty consistent. EPS, though, my lord. Full year 2023 EPS of $3.08. Full year 24 was 75 cents. Ouch. But gross margin increased.
You see the returns on capital? 20% over the last 5 years, 25% last year.
I wonder how they're structured debt-wise. Let me pull up their SEC filings. I want to look at their debt.
Not much. They don't have a lot of debt, Dalton.
No?
Although they don't have a lot of free cash flow either.
Well, they did 160.
You're right.
So
their enterprise value, according to my formula, is $10 billion versus their market cap of $9.5 billion. That's a $500 million in debt on $160 million in free cash flow in the last quarter. Let's see the comparable quarter last year.
Yeah. So they've got $1 million. They got.
Whoa!
What happened?
They only did 15. Is this correct? Oh no, free cash flow. Sorry. Yeah, 15 million in free cash flow in the fourth quarter of 23.
Was that when their stock was at like an all-time high?
When did they do 160? Was it in September? They just reported, right?
They just reported, yeah.
They reported for December of 24, right?
Yes. I was just reading.
So their free cash flow is up 10.6x. That's a huge number.
Let me pull it back up again. That's what I was just reading.
Wowza.
Yeah, February 4th. And this is saying free cash flow of 159.2 million. And ending cash and restricted market.
Although 2 years ago in 22, their free cash flow was 238 million.
Yeah. So they have due within 1 year, they owe 1.1 billion. And then due within 1 to 3 years, they owe another $500 million.
They don't have a lot of debt.
Which is good. I mean, if you're in a new product and it's going to be kind of shaky in terms of adoption, you probably don't want to have a lot of, maturities and debt coming.
Well, yeah, but that's not the way a lot of CEOs think.
I know. That's why most of them suck.
All right, let's do Chipotle Mexican Grill.
The portion sizing kings.
Down 2%. Down 2%, but near all-time highs. They hit all-time high in June of $70 a share, essentially. That was right after they did their split, their 30-for-1 split. Was it 30-for-1?
I think that's right. I think it was 30-for-1.
50-for-1. 50.
So Scott Boatwright was who took over after their CEO left. He was from Arby's.
Gotta love the Arby's.
And then
a big beef and cheddar.
Interim chef, executive chef. Okay. So he's like...
Wait, interim executive chef?
So Mr. Boatwright previously served as an interim chief... Or no, I read that wrong. I'm dyslexic. I was thinking food. Chief executive officer since 2024. Prior to that, he held a role...
I literally was like, how did the CEO work as the executive chef? I'm like, maybe he's trying to be like, hey, I'm here with everybody.
Yeah.
Dalton.
Boatwright named Nation's Restaurant News Operator Creator of the Year. Prior to that, he spent 18 years at Arby's. Arby's isn't public, is it?
I don't know, but I love it.
He's
Arby's
also on the board of Academy Sports and Outdoors.
Is he really?
That's one of the value people I've been looking at.
Yeah. Have you gotten into Value Investors Club yet?
I'm waiting. My application's still...
When did you submit it?
December 19th.
I was going to say, it was like a month ago. It's more than that.
It's been a long time. It's the longest I've ever actually been in consideration. Usually they immediately send stuff back within like a week. So we'll see.
How long was your write-up?
4 pages.
That drives me nuts. Like, I look at it going, how does a Value Investors Club who they value simplicity?
Yeah.
That's one of the biggest things about value investors. They value simplicity. And your write-up was 4 pages long.
Yeah.
If you ever sent me a 4-page write-up, I might fire you.
Anytime I've ever done anything more than a page, I don't think you read it.
That's definitely true.
Should we do Atcore too?
Yeah, we got to do Atcore because that's what the people want.
What the people want. That's what we'll give them.
Atcore is even. It's selling for 7 times free cash flow, 6 times earnings. But their free cash flow in the last year is a lot lower than their 5-year average free cash flow. What did they report? They reported $661.6 million in revenue versus $678.7 million expected, but they beat on earnings. 163 versus 150. Hey, Brad, Hansa's right. Everything I avoid will rocket. You're right.
So then, for those that are interested in what Atcore does, they do metal framing, plastic pipe and conduit, electrical conduit. And the other thing too, I think with commodity stuff overall, I think it's important to note those things do better when there's like real economic growth. We've had a decade of the lowest decade of economic growth, real economic growth in recorded history.
Is that accurate?
That's accurate. That's absolutely accurate.
Really?
Yes. So
worldwide or U.S.?
U.S.-based GDP growth. Because think about it though. We tried this whole cut rates to nothing trickle down effect, and it didn't work. Like we haven't built physical things, and so the downturns in cyclical businesses have been worse.
I call BS. Real GDP by year.
Look up 10-year GDP growth.
Yeah, here's real GDP. Yeah. What year is this for? That's a lot of growth, my friend.
But if you compare it to other 10-year
Oh,
periods,
I get what you're saying.
It's incredibly low.
Okay, so we went from 18.5 to 23.5, which is 2.4%. Okay. Now let's do the previous.
The people want FMC. You guys want Technape? Paul might fall asleep if I start talking about FMC.
Bro. Oh, son of a bitch. $18.5 to $15.5. No. That was lower in the previous 10 years of that.
Well, what I'm saying though, but from the after the global financial crisis to today, like that 10-year period ending the global financial crisis when rates went to nothing, to basically when rates started to be
this is real GDP growth right here.
Post-COVID. But I'm saying that the period that I'm talking about is when we cut rates to nothing, kept them low for 10 years. That decade was shit.
Oh, I think you said the last 10 years.
Sorry, if I said that, I need to correct myself. It was from the time that we cut rates to nothing for that decade-long period. That growth was nothing.
Okay, let's see.
It was anemic.
01/01 2010. Mother F.
Debt maturity profile. Accor, another thing about Accor is they have like no debt coming due. They have some stuff due in 28, but then most of the debt they have are senior notes due in 2031.
Dalton, still pretty decent. 2693 divided by 16,582. Power of 0.1. 2.2%. Not bad.
But the whole point of that was like there was going to be some explosive growth. And
I don't think that was the point of it. I think the point of it was to avoid calamity.
But I think it was the intent to start. But then it was like.
And by the way, nominal growth was very explosive. People sometimes don't really care about real growth. Like the average person, they'll sit there and say they care about inflation. No, they care about surges in inflation. They don't care about inflation so much as surges.
It's like if they can't predict what inflation will be is when it becomes a problem. Like in the 70s.
Of course, exactly. Yeah, that's what I mean. Like surges. That's what causes surges in inflation. But 2.2% real growth over that 10-year period, it's nothing to write home about, but we're a very, very mature economy. Add in inflation in there, you're at 4 or 5% all day nominal.
But if you compare that to like financial assets, like stocks in that time versus like the actual growth.
Well, yeah, but where were they coming from? They were coming from very depleted levels and got to very, very high levels of valuation. We were essentially in the start to middle stages of a secular bull market. That's I get what you're saying. Like the 80s saw a major increase in stocks and also saw a major increase in lifestyle, blah, 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 blah. I get that.
It used to be, though, I guess another point I'm trying to make is it used to be that when you had a recession, the economy slowed and the stock market slowed as a result. Now the recession is, what is the stock market doing? People don't care about what the actual economy is doing, it feels like. It's the stock market's down.
Maybe.
That's the real recession.
Maybe. I'm not going to deny that fully because I haven't really thought about that. I don't know. I don't know.
Let's see. People want FMC. Let me look at Technique really quick.
What's FMC?
It's Technip FMC. It's an offshore
drilling.
Well, they do like the trees and stuff that make it possible to be able to.
So the question for Adcore is, when's the slide going to end?
So that's the hard part. I mean, here's the thing. If you're a believer that electric build out of cars and electrifying the world is going to be a thing, like solar panels and wind turbines and stuff, you need a lot of electricity to run and operate.
It's going to be nuclear.
It will be at some point. I think it's where we're heading.
We have to.
We have to. If you truly care about, here's the problem I have too, Paul. everybody that talks about energy and like emissions, they don't actually care about emissions. They care about human impact on things. They put human impact over human flourishing. So it's like,
oh, that's very true.
So it's like it's not about the actual emissions. It's about, well, are you impacting something? Are you having to cut down a tree? It's like hydro. Besides nuclear, hydro is the most efficient form of energy we've ever come to know. But people don't want to do it. Well, that displaces some native species. Okay, do you care about that, or do you care about the existential threat that you?
Now we're talking about. That's basically political views at that point.
Sure.
It's like when I sit there and tell people, I'm like, listen, we have plenty of land. We have plenty of trees. When I hear people talk about not cutting trees down, I go, do you realize how much land we have?
Yeah.
Nuclear energy has a bad rap.
Yeah, it's political.
It's completely political.
You guys are saying FMC, but I'm looking at Technip right now, and I don't see what you guys are talking about. Can somebody please help me here? I'm happy to talk about it, but I need to know what we're talking about.
All right. Guys, we got about 10 more minutes. Neo. Oh, Neo sold that many more cars, huh? That's interesting. I didn't know that, Hans.
They're talking about FMC.
Holy shit. Look at Neo stock. Guys, look at this. If I don't know if Hans is right about this one. They sold 10 times more amount of cars in 24 than in 19. Let's go look that up. Neo cars sold by year. Oh, yeah, he's right. And you know what the funny part is? Look at the stock. It's basically at where it was in 2020. And in 2019, it's a little bit higher. Stocks are a voting machine. Stocks are a weighing machine. Let's see their numbers. Listen, I just don't like car companies. It's hard for me to get around a car company. Gross profit of 9%. Oy. A lot of debt, negative cash flow. Like for me, Neo is not the play for me. I guarantee the number of shares they have is just issuing is just mind blowing. Look at this. They had 1 billion shares in 2019. They have 2 billion now. Yeah, the company's a lot better in terms of number of cars sold, but at some point for me, listen, you guys got to remember the way in which I look at investing may not be the right way for you. Look at Dalton and I. We differ very much in how on the companies we buy. We approach investing the same way, but I like to buy more mature companies that I have a much easier time predicting. Look at Uber. Even Uber, I'm like, man, how do I predict Uber's growth and free cash flow? It's a lot harder for me.
Yeah. I have a question for you, Paul.
I have an answer for you.
Can you run a quick stock analyzer on Atcore? I want to see if you get anywhere close to where I just was.
I remember it being very, very good.
Because I made stupid assumptions and...
Look at my assumptions. I did -2, 1, and 4.
Yeah.
Revenue growth. What'd you do?
I did 0, 1, and 3.
Okay. Profit margin, I did 10, 14, and 18.
I did 9, 11, 13. I did that for free cash flow too.
Okay. PE, I did 12, 15, 18.
I did 7, 9, 11 for both.
I mean, it's absurd.
Yeah. And I'm getting low end 70, high end 150.
I mean, yeah. So the question becomes, all right, let's go even crazier. Let me go -4, -2, and 0.
And here's the question.
8, 10, 12. 8, 10, 12. 7, 9, 11. 7, 9, 11. Yeah, that's absurd.
The other thing too, Paul, to ask, and I know this is probably not the way you would invest with people, maybe other people in general, is like, at what point is it so cheap that we don't need to know when the tide's going to turn, but you're just buying so cheap that it's like, eventually it's going to, I believe in the product.
And is that the case with Atcore? I think you need to add Atcore to your, let's do a deeper dive look for Atcore for our portfolio.
Yeah. And maybe I'll throw an exclusive content out there here if people want.
I mean, it's only $2.24 billion company.
Yeah.
The funny 52-week high was 195.
Their returns on capital are pretty good too.
Yeah, they are. So we got to understand the business, why it's declining, and what drives the business revenue and profit. That's what I need to understand.
Well, part of it is too, so they make this PVC conduit. And so I don't mean to bore people, but when you think when you think about like PVC, you think about like epoxy resins. Prior to COVID, China built up all this capacity to build out this green.
There he goes with China capacity.
They built out all this green infrastructure. COVID hit and they had all this excess.
Have you seen
supply.
Severance?
Severance?
Yeah.
No, but AJ has told me about the show and said she wants to watch it with me.
It's a good show.
Yeah.
I think every time you bring up energy, I wish I had a Severance like thing in my head that just split me off so I didn't have to experience it. I can come back to reality and going, okay, Dalton's done talking about energy, and it's the second you mention energy, like AI should know you're speaking energy, and it just goes like this. He goes, because in the show when he goes down the elevator, the workers like that, and then he's a totally different person. I hope everybody here understands.
Chat. My goal is to turn Paul by the time he's retired into a oil and gas
billionaire
magnate.
Yeah, that's what he wants to do. He said this last night in text. It's like, I hope you're 70 and like, you know, becoming the oil magnate. I'm like, no.
You know what we're going to do by the time we're all done? We're going to buy Cleveland Cliffs and we're going to own the big steel production.
You know what's funny about this? My goals 15, 20 years ago, like I had a deal to buy part of the Miami Heat. My goal was to get with the Miami Heat, own my own team.
Yeah.
I told you I was meeting with Scottie Pippen to buy a team, et cetera, right?
Yeah.
I have no desire to do that anymore.
No interest.
Because I look at it going, one, having to deal with like the public would be awful.
Yeah, it would.
Two, like what's the purpose of it? I enjoy being a fan.
Yeah.
I can be a fan. I can sit there and enjoy the games. I can watch the game. Last night we lost the Celtics. We came back within 4. What was that? What, owning a sports team?
Yeah,
yes, it would. But, you know, we were watching the Celtics game last night. Like, Tim and I are texting, and it's like, but you know what? We have a title. I move on.
Yeah. You know what we haven't hit yet, by the way, before I didn't cut you off?
Yeah.
We haven't hit Google or PayPal yet.
Oh, my God. Let's go hit up Google.
Yeah,
we did them both in a...
That's true. That's true.
But anyways...
It's down 8%. Google.
So when you say to me, like, if somebody said to me tomorrow, Paul, when you're 70, you could go become an oil billionaire, I'd be like, nah, that's okay.
Yeah.
Like, I know people think that's insane, but I'm like, you've seen my changes.
Yeah.
After we talked about money and all that stuff, it's like, why do that? I don't want the hassle.
You would rather spend 5x than do that.
Yes, I'd rather spend 5x, knowing that I can afford to spend 5x.
Paul, what about a G League basketball team? Would you do that?
So those are no longer, we were looking at one after the NBA deal fell apart. They're no longer, I think they're only selling to like NBA franchises. They want the G League to be part of an affiliate. Because before they were kind of independent.
Because how fun would that be?
When they were called the D League, the Development League. Oh yeah, that'd be fun.
That would be fun. Fly under the radar.
The Erie Bayhawks, was it? Back in the day?
Yeah.
That was, somebody offered me a partnership in there, and I'm like, no, if I'm gonna do a G League, I want to own the team.
Yeah.
So
back then you could have bought a G League team for like $500,000.
So the Quad Cities,
would be epic.
The Quad City River Bandits are the feeder team for the Pittsburgh Pirates, and they're like right in our backyard. And we go watch a couple of games every year because they'll play the Peoria team that is the feeder for the St. Louis Cardinals.
Peoria. Yeah, Google's down 8% now.
Yeah. What do you think about Google? What's your
what's my price on Google?
What's your price here?
Let's look it up.
Because I'm sure too, like
look at my assumptions. Ugh.
The business has improved since the last time that you've analyzed it, I imagine.
Okay, here are my assumptions. 4, 8, and 12% revenue growth for the next 10 years. What do you think?
Yeah, I mean, for me, I think just because I guess is my nature, not necessarily when I know something big. I would probably have done like 3, 5, and 7, or 3, 6, and 9, or something like that. Just
why?
Because a bigger company, 2.3 trillion. My game.
Don't worry about it. Mo does the same thing.
No.
Don't worry about the. Look at the revenue.
I'm just saying, like, I'm saying more for like the way I invest. This is not something I'd want to own unless it's like screaming. Like Meta at 88, that's the large cap I would own because it was so obvious.
Got it.
I need something super cheap.
Fair enough. Google. Profit margin 22, 24, 26.
I think they're gonna probably grow that even more.
So that's the thing. Here's the hard part. We don't have EPS growth in here.
Yeah.
We're driving it based on profit margin and free cash flow margin. Yeah. With revenue growth at 4, 8, and 12, I have to think the profit margin will go better.
It's going to be insane. They're going to have 30% profit margin if they grow at 12% all day.
Oh, for sure.
And maybe even more.
PE, 20, 23, 26.
20, 23, and 26.
I could argue higher.
You probably could.
If somebody told me middle number of 26, I'd be like, yeah, it makes sense.
Yeah.
I mean, I look at this.
I find it hard to believe it's not going to sell for 24, 25 times earnings.
All right, then my 9% return. Hit the analyze button. The stock's at 191. It's selling basically where I think its intrinsic value is.
Are you going to buy 100 shares?
No, I'm going to go back in time and shoot myself for not buying it at 85.
Our friend Mo bought a little bit.
Yeah, Mo bought it at 140, I think.
And then PayPal. What did you think about PayPal? You think that's
What'd you say, Tim? You bought it 136 or Mo did?
Oh, no, I bought lower than 136.
Oh, look at that.
I pressured
Look at
Mo.
that.
I pressured
Whip out
Mo
the dick.
to buy at 136.
Whip out the dick and show how big it is.
No.
I love it.
No, every day.
Oh,
I was
my
like,
God,
Mo,
that's
are you
incredible.
buying?
I'm going to do my assumptions on PayPal. We'll see what
yeah, we did the video yesterday on the 24/7 channel. But I'm going to pull up PayPal now.
Dude, the revenue growth for PayPal is pretty impressive, actually, for something that people are saying is...
I think I got to alter these assumptions here.
How much of a premium do you think something like PayPal should sell for?
So I actually put, on the low side, 14.
I think that's probably right. I mean, it's really competitive.
I did 14. That's exactly why I did that. I did 14, 17, and 20.
Let me ask you this, though. So
Ask me.
As like a PayPal shareholder, do you think it's overblown, the Apple Pay stuff? Because I feel like Apple Pay is more of a replacement for a credit card.
That's exactly what
more than like a
yes, I
online
don't think,
transfer.
and maybe I'm just biased. I don't think it's the same thing.
I don't think it is at all. I think they're totally different products.
Look at this.
Yeah.
I've got a low price of 60 to 75. I got a high price of 130 to 190. I got a middle price of 90 to 120.
I had a low price 66 to 50, and I got a high price of 108 to 127, middle of 92 to 75.
Again, probably for him, it's because he's like, it's got to be such a obvious deal. And guys, I'm very proud that I was buying PayPal $50. And if a bad bear market occurs, you know, PayPal is a high market cap business in the NASDAQ. This is going to suffer, and I'm really looking forward to that time. Guys, we got 1 more minute left. Go Easy is becoming very interesting. What's Go Easy?
Go Easy is an installment lender in Canada. It's probably, honestly, in terms of combination of like quality and price, is probably the best opportunity in Canada right now. They grow.
Wow, look at that. Ant of the Sky. Do you know him?
Yeah, no, I don't. But we talked about it in the chats because they're right at that 2 billion threshold, and I've been watching them for a while.
Is that the one you talked to me about a while back?
Yes, they're an installment lender. I could do an hour seminar on Go Easy. They're an incredible business.
We'd love to hear it.
Paul would be.
You know, when Dalton and I go through my like goals for the future on returns, I'm very conservative. And I believe I can outperform the market by a couple percentage points a year plus options. If that happens or not, I don't know. But I look at it going, you know, the old days of wanting to make huge returns as much as possible don't exist for me anymore. Because I'm more about like, okay, how can I enjoy my life and make sure I always have plenty, but also really, really have fun spending and enjoying money, which is a very beneficial place to be in life.
I'm going to eat ramen noodle and try to make a couple bucks in the meantime.
That'll change. Listen, I see that video of Jeff Bezos driving his Honda Accord when he's worth $9 billion. And I go, oh, every rich person goes to this. They become rich quick, and then they go, I'm not going to change. Just like Mark Zuckerberg used to drive his Acura RX, which was like a $35,000 car. And now all of a sudden Zuckerberg's got like 18 Pateks that are worth $1 million each. He's got $1 billion compound in Hawaii that he's building. I'm like, I don't want to hear it.
Yeah, like it's once they realize that they're living in their means to do that they
I think you just got to get accustomed to it. Like Tim, even your spending has changed, right? As you started making more money, you started spending on nicer. Now, Tim's still not spending like crazy, but
we value
well, forget about that. You're still buying like you bought those $300 boots. You bought a nicer used car.
Yep.
Tim, if your income went up, when your income goes up 10x from today, you're not going to be living the same way.
Oh no, absolutely not.
But that's the thing. A lot of people think they're going to. I thought so.
But I think society tells people you should. You can't.
Yeah,
you
fuck
can't
them.
live that way. That's
fuck them. I got the opposite. Go ahead.
At the same point, we'll make sure that we're in our means. That's all.
That's all you have to do. Like, look at us. Like, literally, the other day, we're joining a club in Georgia for our lake house that we're renting out. That's the other thing. I buy a lake house to rent it out. I don't even want to have the lake house just sit there because that's the money loser. But we went and paid more for the next extra membership, even though we're not golfers. We're like, listen, it's 2 courses versus 7. Let's do the 7 courses. It's only a one-time fee difference. It's a couple $100 a month difference. Fine. That's the kind of stuff I want to be able to do. Yeah. Guys, 11:31. Thank you very much for your time. By the way, Jeff Bezos has multiple private planes. And he does not drive a Honda Accord anymore. This is back in the day. This is back in like 1997.
You seen his new lady?
Yeah, I think she's weird looking. Lauren Sanchez.
Yeah, Mark Zuckerberg seemed to like her at the.
Yeah, did you see that? Yeah. And then all the memes about him showing his wife. He's like, look, if you look right here, I was like right there. It's so funny. Guys, thanks for the support. I appreciate it.